This content is general in nature and should not be considered financial advice. Please listen to the full disclaimer at the end of our podcast. Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today we have a repeat guest from previous appearances, David Bassanese, from the Chief Economist from Betashares. Welcome back.
Great to be back with you.
So, a bit of background again for those that might have missed the previous podcast, because David, the last one, he's been on here maybe 3-4 times now, but we only just realised that he hasn't actually been. We haven't done a podcast together since late 2023. We sort of committed to doing it every 12 months, but time flies when you're having fun, I guess. But for those that missed those podcasts all those years ago, bit of background about Betashares if you haven't heard of them. They're Australia's largest ETF manager, I believe.
I wish almost. I think Vanguard is still in terms of total stock of ETFs, but we're second to Vanguard.
Is Vanguard Australian?
Oh, Australian, yes. No, for sure.
Yeah,
in terms of Australia.
Australia, yes. I think it's its largest one.
Yes.
55 billion in assets under management. And ETFs, diverse portfolios and innovative share type ETF solutions. I'm not just saying this. It's my favorite ETF sort of fund manager. I think I've got, I'd say 90% of my ETFs are Betashares ETFs.
You're a very astute investor.
Yeah, well, I've listened to you over the years and just followed some of that. And yeah, we'll get to some of my favorite ETFs later, actually, because I did want to touch on that so people actually understand what ETFs are and how they provide access to different investment strategies. It's more of a modern day type of investing. You know, I think historically people used to invest in active funds and fund managers that were buying and selling throughout the years. This is more of a passive approach, but still sort of giving exposure to things that people don't typically invest in themselves.
Yep.
But before we touch on that, because there's over 100 funds there that we could dive into. No, almost 100 funds, I believe. Let's talk about, where we left off last time we spoke. Like I said, late 2023. And I did ask you a bit of a crystal ball forecast back then, which is right in the thick of, the interest rate instability, I should say. We'll probably start with the forecast we had back then from you, if you don't mind me jumping into that. I did ask you, where do you see rates? When do you see rates start coming down? And I think we said late 2024, second half, when it ended up being earlier this year was the first cut in Feb. Which, to be honest, you're far more accurate than the major bank economists.
Oh, thank you.
They were saying start of 2024 from as late as mid to late 23. They were still forecasting that. We haven't seen as many cuts as we'd like. We were hoping for about 1.5% worth of cuts was our last conversation, ended up being about 75 basis points, but that's just obviously from ongoing data being released that doesn't justify future cuts, right? Which probably then is a perfect segue into one of my first questions I want to talk about with you today. The global economy, we've got so much uncertainty and so many contradicting statements and forecasts on where we're going to see inflation, interest rates taking us next. Most recently, the monthly indicator came out, which was a bit too warm were the words, I think, in the AFR of inflation.
The local inflation.
Local inflation still running hot. If we want to talk about US inflation, it kicked back up. So it's, if I see inflation increasing locally and in the US, economists would say it doesn't justify any more rate cuts. If anything, we have to be cautious of a rate rise, which was recently commented in the AFR as not completely out of the question. But then you've got Trump talking about, how he's going to cut rates by 1.5% and basically trying to restructure the US Fed Reserve to suit his ambitions of lower interest rates. So, that's a bit of a broad question to answer, but Tell us your thoughts
Sure.
on all that going on right now.
Yeah, let unpack a few things there. Let's talk about Australia, talk about the global economy and the US in particular. I mean, firstly, in terms of Australia, yes, I mean, rates have been coming down. It was probably slower than we thought, a couple of years ago, but, they did come. It wasn't too far off the mark in terms of the timing, but it all really come down to how quickly inflation would come down, whether the economy would go into recession. The good news is that we didn't go into recession, so we didn't need the RBA to slam, cut interest rates aggressively. Inflation has been coming down, and as it's been coming down into the band, the RBA has been able to take the foot off the brake.
It was that soft landing that everybody hoped for.
Yeah, and I think there's a few, there was a few months there where inflation, didn't come down as quickly as we'd hoped. There was a sort of a pause in the rate of decline. Yeah. So, this time early last year, there was, talk of certainly sticky inflation. Maybe it wouldn't be coming down, but it has sort of more or less come down. It's now, I focus at the moment on the underlying measure of inflation. The headline measure has been heavily distorted by electricity subsidies at both the federal and state level. So whether they're on or off, it can lead to that headline number bouncing around. But the underlying measure of inflation is called the trim mean. Now, as you pointed out, we do get a quarterly and we get a monthly measure of
and all eyes is on the quarterly, right? The monthly isn't that reliable.
So a couple of points. So the monthly, generally the RBA look through the monthly number because it does tend to bounce around, but they do glean some information from it at the sort of more micro level. So there's some elements in the recent monthly CPI for July that the governor made note of at the recent monetary policy decision,
being cautious,
where they didn't cut rates. They said they saw some upward pressure on housing construction and services. So the bottom line here is that they've cut interest rates. We've started to see consumer spending rebound a little. We've started to see the housing market rebound a little, obviously in prices and construction. And that started to create maybe the rate of decline in inflation in those areas has slowed a little. And so that's why they've been cautious. And so so the monthly number they tend to discount, but they did see some information. But it all comes down just in terms of interest rates in Australia. We do get the September quarterly CPI, which is the all-important measure of inflation. We get that in late October, and that will really dictate whether the RBA cuts rates in November, and really the course of inflation over the next 6 months or so is going to dictate whether we get more rate cuts or not. If inflation does keep easing back into the middle of the band, around 2.5%, as I expect, over the next few quarterly reports, I think the RBA is still on track to bring rates back down to a neutral level. A neutral is 3%. And at the moment they're 3.6, so we're still above the neutral level of interest rates.
Is that neutral based on the last 10 years though? Because wasn't there some comments about potentially reviewing what's the neutral level of where interest rates should be, and perhaps what's happened the last 10 years isn't going to be necessarily the same as the next 10 years in terms of that ideal interest rate level?
Yeah, look, no one exactly knows where neutral is. I mean, we used to think it was a 2.5% at one point. The RBA kind of thought, a few years ago when interest rates were so lower for longer, and we had inflation lower than we would like,
1.5% for like a decade.
Yeah. At the moment, they're kind of saying we think neutral's around 3%, but it's a kind of suck it and see approach. We change rates and see what happens. If they cut rates and the economy's not moving in the direction they want, that means maybe that's not stimulatory enough and we need to cut rates more. But at the moment, the sort of base case is we think neutral is around about 3%. So provided inflation comes back into the middle of the target band, everything should be back at sort of, normal levels. At the moment, normal is 3%. So that's my kind of outlook. Yeah.
So all eyes then on the quarterly data coming out end of this month for local inflation.
Yeah.
And that's why I think economists were talking about a rate cut potentially in November because it was the reaction to the end of October quarterly data that comes out for the quarter prior. I think that's off the cards in my opinion, and I don't think we'll see one till Feb, if that at best. At the same time later this month, I think it's even the same day around the 28th, we've got the US Fed having their meeting on interest rates. Now, is there a concern, elephant in the room, but if inflation is ticking upward in the US economy, and Trump, with his own motives and ambitions, forces rate cuts somehow. I know technically he's not meant to, but I don't think he normally follows the rules. That could easily just trigger inflation again, and then a reaction to that, or when I say trigger, get to an unhealthy level of inflation requiring higher interest rates.
Yes,
that we could see rates sort of go up and down, or down and then up in the near future, right?
Yeah, we could. I mean, so in terms of the US at the moment, the underlying rate of inflation, if you look at their consumption deflator, which is the one that the Fed focus on, that's at 2.9%. Fed's target is 2%, so it's above where the Fed want it to be. But that's the bad news. The bad news is above target. The good news is that it could be a lot higher given the tariffs. The tariffs have come through. The increase in tariffs potentially could have added like 1% to inflation, because the total increase in tariffs, imports are about 10% of consumption. They've increased the tariff rate from about 2% to 18%.
Which trickles through onto the cost of goods.
Yeah.
So it's kind of like when we introduced GST, the same net effect, right?
Yeah, but what we've seen is that we haven't seen is a big flow through of the tariff effect. So it seems at the moment businesses are absorbing the tariff, not passing it on into prices.
Yeah, that's good.
But it still means that inflation is still higher than what the Fed would like. So the question then is, why is the Fed cutting rates and even thinking about doing it? It's because we have had a slowing of the labour market. So employment growth in the US has slowed up to very soft level at the moment, and the Fed is now concerned that maybe we may see too much weakness in the labour market, so they're providing some stimulus from interest rates. So that's why they cut rates just recently at the September meeting, and probably on track to cut rates a couple more times this year. Notwithstanding the fact, as you point out, inflation at the moment is still higher than they would like it to be, but it's a balancing act. At the moment, interest rates in the US, as in Australia, are at restrictive levels. In fact, they're more restrictive in the US than they are in Australia. So they've got more leeway to, again, take the foot off the brake a little, given the higher downside risk in the labour market. So just on Trump, I think part of what Trump does is for show.
Yeah,
right?
yeah.
Why does he beat up on Fed Chair Jerome Powell? Because he can.
Yeah,
because the guy can't fight back. He's got his role to do, and
he loves the theatrics.
Yeah.
Liberation Day was very theatrical.
And look, if the worst case scenario is that Trump, gets rid of Jerome Powell next year, installs a Fed chairman, everybody basically does what Trump wants and cuts rates to 1% because he says they should go to 1%. Now, that will light a fire under the economy, under inflation, as you point out. And the thing about the US market, the mortgage market there, mortgage rates are more determined by the longer end of by long-term bond yields.
Because they're 30-year fixed mortgages.
Yeah.
Yeah, so probably good to call out that the central bank's sort of cash rate in the US has a very different effect in the economy over there than it does here for the RBA, right?
Yes.
It's probably, if we're talking about immediate effects, it's probably more business finance and commercial finance in the US that it impacts immediately, because it only affects new loans in the US, new housing loans, because everybody takes a 30-year fixed mortgage. There was what's his name, Larry from BlackRock, who came to Australia.
Promoting that idea in Australia, as well.
Who was suggesting that we should be taking 30-year fixed mortgages here.
But the consequence of that is that if they cut rates to 1%, yes, you can control the short end of the market. You can control short-term interest rates, but you can't control the long end. And if the long end fears that will lead to inflation, and if it does, and bond yields go up, mortgage rates will go up. So we'll actually have a perverse effect on the economy. So that's why I think ultimately, Donald Trump loves to talk the talk, but I don't think, he would see the risk of just forcing the Fed to cut rates to 1%.
Well, there is a famous saying going around at the moment called the taco effect. The
taco charade,
the Trump always chickens out, I think it stands for. Yes. So just like the tariffs, I think he talks a lot, but we'll see what actually comes to fruition. So all in all, just to, I guess, circle back on the global economy and what's happened since we last spoke, it looks like we've had that soft landing. Rates are getting toward neutral, whatever neutral may look like. Equities. Let's talk about your bread and butter, right? I forgot to mention in the introduction, you've been at Betashares now as the chief economist for over 10 years, or approaching 10 years. So you've seen a lot. Obviously, you've got a career before that, but you've seen a lot in global equities. Nothing quite like what we're seeing at the moment, I imagine, though, with multiples on valuations at crazy levels. I think probably the most similar period of time we can relate this to was probably the dot-com era, and that didn't turn out too well.
No.
And I'm not going to say that you're bearish as such, but to put words in your mouth. But let's talk about how there is very aggressive, what it seems, in my opinion, very aggressive AI productivity improvements already priced into a lot of these valuations in tech stocks and even some of the mid caps or large caps in Australia and other big businesses. And things are seeming a little bit top heavy in equities markets.
Yeah, so let's start again. The US market at the moment, the S&P 500 is trading at about 22, 23 times forward earnings. The highest level since the late 1990s dot-com bubble, and at the peak of the dot-com bubble, back in 2000, early 2000, it was trading at 25 times earnings. So we're not there.
Oh, okay, we haven't broken records yet.
We're not as high as we got, but we're close.
Yeah, we're close.
But one difference between now and then is that the company, back in those days, we were talking about, dot-com companies that had a lot of potential, but had very little earnings. Whereas now we're talking about blue chip companies that have been around for 10 years that are punching out, 10% growth in corporate earnings. So these are companies that have been around for a long time, and they're getting a rich valuation. Well, certainly up until recently, have got a rich valuation because they've been delivering on the earnings front. Now, as you point out, there is a bit of a extra kick along in terms of valuations because of the AI, potential of AI and what that will do. So, look, and that potentially could be, revolutionary. It could do sort of to the economy what the internet itself did in terms of lowering inflation, boosting productivity in the late 1990s. But, it's still at the moment still a bit speculative in how that will play out. I guess my thinking about the equity market, just like on a 1 year view, yes, the market's at high valuations, but provided, the Fed is cutting interest rates, provided US bond yields don't go up a lot, they stay where they are and maybe come down somewhat. So 10-year bond yields in the US are around about just over 4%. I actually think they can break below 4% as the Fed cuts rates. Now, that will support valuations holding where they are. And meanwhile, current earnings expectations in the US are still very strong. Something like 16% growth in what's called forward earnings between now and the end of 26. So earnings are still providing a tailwind for the market, and I think valuations, provided bond yields behave, should be neutral. They not necessarily signal to crash, but as you point out, we are looking at the AI, and there is a risk. There is a risk things do get bubbly. But maybe this is 1998, 1999, where things were looking frothy, but it went on for a while longer and then eventually did crash. And, going back to those days, there was a lot of investment in the internet back then, and a lot of that investment ended up becoming not that productive and not that fruitful. And maybe there is a risk that a lot of the billions of dollars that are being poured into AI investment at the moment, maybe you don't get the payback from that we thought. So that is a risk, over the next year or so.
If we compare to that period, and just for a few things that to call out, the integration hurdles for businesses back then to get their business online were far less prohibitive, or far less of a hurdle than what we have today with implementing AI into a lot of these businesses. In my opinion, the implementation, I think, is going to be underestimated. And you talk about also the cost of AI, right? These tech companies are building these these data centers, some of them are nuclear powered with like 3 nuclear reactors. You got tech companies building infrastructure that the US military uses for warships, right? Like, it's crazy expensive sort of infrastructure or hardware, and it hasn't actually trickled through to revenue yet, right? If we look at OpenAI's platform, ChatGPT, I think, don't quote me on it because the number keeps changing, I think there's 900 million subscribers to ChatGPT, but there's only like 5 or 6 million people paying for it.
Yeah, it's free.
So
I just started paying for it, by the way.
Yeah,
but I'm one of the few.
Likewise, but what are we paying? Like $30 a month or something?
Exactly.
That doesn't really go far.
No.
Well, it does when you've got, I guess, 5 million users, but paying that, but still, the cost of the nuclear power data centers and the people behind it, the workforce behind it, I think, that cost eventually is going to trickle down into businesses. Whilst there might be some productivity improvements and some efficiency improvements, and maybe even some sales improvements in these businesses, there's the cost of AI, and there's the cost of staff and AI architects or engineers in these businesses actually embedded and sort of make it a part of the day-to-day. But the other thing I wanted to call out, I guess it's probably different to back then, correct me if I'm wrong, you would know more about this than me, is there's an incredible amount of money flowing around the economy post all this stimulus out of COVID. And has that somewhat got to do with these really high valuations?
I'm not sure. I mean, people, talk about a lot of, I heard the same thing 20 years ago, during the dot-com bubble, a lot of money floating around, a lot of liquidity. Look, I think money, the investment pool has been rapidly, growing and around the world. And I think today, I don't really get a sense that it's a wall of money. There's structural shifts like private equity. A lot of these companies, I guess one difference is that a lot of these companies have come to market more richly valued than they were in the past. Back in the old days, a lot of companies would list still in an early stage of their growth potential, whereas now a lot of companies are sort of sheltered by private equity firms for longer.
Far less IPOs.
And then they sort of come to market later at a higher valuation. So I think there's part of that.
A good example of that would be Guzman and Gomez, right? They had PE funding, and they've scaled, and then they've only become a public offering once they're
exactly.
$2 or $3 billion business. I think.
Certainly in the case of Australia, the IPO market is at the moment. So there's a competition for investment, between the going through the listed route, through an IPO, or being have a private equity business invest in you. And you can, like our business, for example, at Betashares, we have private equity backing. People often ask us, are you ever going to go and list on the market? Who knows? Maybe we will one day, but at the moment we, don't really need to. We've got private equity investors, and we don't feel any compulsion to sort of go and do that. Above my pay grade to make those sort of decisions, but there's an example of of the role of private equity that's playing at the moment.
So let's talk about some of the I guess trade concerns with the global economy, and how that landscape is rapidly changing, especially with once again Trump coming in and sort of starting off Liberation Day to start this year with a whole lot of tariffs that I think he's only imposed, like, out of the, what was it, like 30 countries he had on that big signboard. I think he only actually successfully implemented like 3 or 4 countries worth of trades.
Trade deals.
Yes.
He's imposed tariffs on a bunch of countries, but not without any deal.
And I think there's been definitely, since Trump has come into administration, a bit of a changing attitude with our relationships with China, right? And things are getting a little bit, I guess some of that is before his time, so we can't just blame Trump, but there's some contentious subjects there. And one that just came out real recently, which I feel like flew under the radar and didn't actually impact one of our biggest companies on our stock exchange as much as I would have thought. But BHP and China, putting a ban on their iron ore trade. That's our biggest export, I believe. $100 billion worth of iron ore gets exported to China by BHP. That's why they've got those super taxes on that trade, I believe. makes up a huge part of our overall tax revenue for the ATO. What's your view on some of these, I guess, trade negotiations? Because it does seem like a negotiation, given that BHP was still, shipping off iron ore. It was still leaving the dock even post this ban. So I think they had thoughts that it would be resolved by the time the ships got there.
Yeah, look, at the end of the day, it certainly pales in significant. It's certainly much bigger than the ban that China at one point imposed on barley and red wine and these sort of things that would attract a lot of iron ore is the big elephant in the room, right?
Yeah,
but
the thing, it's not as bad as our wines and lobsters.
I mean, end of the day, China needs our iron ore, right? They have massive steel production capacity. It needs to be fed by iron ore. It comes from us. It comes from Brazil. China produce some of their own iron ore, but it tends to be very low quality. It's very expensive to process. It creates a lot of carbon emissions. They don't recycle steel a lot through scrap. So I think markets are a little bit shocked, at one stage shocked, but ultimately it's not a credible threat, I don't think, because ultimately China can't just stop and say, we're not going to take your iron ore, because their steel industry would collapse. Employment in many regional areas would collapse. So I think it's, just a part of a negotiation that's going on, but I don't think at this stage investors, it's such a big a cost to China as well that it just doesn't seem a credible threat.
So look, you just touched on something which is interesting that I've read briefly about our quality of iron ore being a concern for China, right? It's harder to manufacture and they're moving to different manufacturing plants. Right. Is that what you were touching on?
Well, look, I think they're moving. End of the day, I mean, we have some of the best quality iron ore in the world, in terms of its purity, and that's what's been attractive for China for many years now. Look, in terms of shifting of their manufacturing, I don't think that changes the situation now. They are still producing a lot of steel and actually still producing probably too much steel, and they're exporting a lot of their steel. It's causing problems in steel markets around the world. But, until they decide to, cut back on their excess capacity in steel, they're still going to need iron ore, as far as I understand. And that's why I can't see them, walking away from our iron ore, because Brazil can only supply some of it and they definitely can't supply what they need themselves.
Is there any other sort of global uncertainty around our trade? China's obviously our biggest trade partners.
Well, just on obviously the US, I mean, there's actually some discussions or some suggestions now that the US tariff policy, imposing, we actually got off fairly lightly. The tariff on Australia is about 10%. Some other countries have got higher tariffs. And so in a way, it actually can be open. We're becoming more competitive against some other countries exporting into the United States market. So that's one argument. Second argument is that a lot of countries are now, shifting their focus away from the US. And so we're benefiting maybe from cheaper imports from countries that would otherwise try to import into the US are now looking for other markets, Australia included. So that puts good. We get cheaper imports than we would otherwise get. So there are some, given that the tariffs were pretty light on us, and the US is basically shooting itself in the foot. Like Donald Trump thinks this is all great for the US economy, but it's not. It's hurting its trade. It potentially can benefit Australia. So just on, so the tariffs, they have gone ahead. The US is raising $250 billion a year extra from tariff revenue. So they are, they have increased tariffs, not as much as we initially feared back on Liberation Day. Again, just some order. Back on Liberation Day, the average tariff based on his announcement was close to 30%.
Yeah.
At the moment, it's the average announced tariff is about 18%. But if you look at the revenue they're collecting, it's about 8% of imports at the moment. So the effective tariff rate is gone from about 2.5% to 8% based on revenue collected to date. So
it's actually a successful policy that Trump has somewhat introduced, right? Especially because it's not being passed through to consumers on price.
Yes.
It's mainly being absorbed by businesses, and these businesses are taking arbitrage of getting things, manufactured in cheaper marketplaces. So if they've got that extra margin to play with, so be it on the tariffs, I guess.
Yeah, well, look, it's successful in the sense that, the US has a large budget deficit and everyone said they need to raise taxes. Well, this is a tax increase.
Yeah.
And then I guess the other, I think, aspect is that we haven't had the retaliation from other countries. One of the fears earlier this year is that would lead to a tit-for-tat escalation. Now, we have seen it with China, but the US and China, they're kind of still in a ongoing negotiation. But Europe, for example, Japan, many other countries basically rolled over and accepted the tariff that Trump imposed just to get it over and done with. So that was pretty key. China and even Australia, we now have a 10% tariff, but we haven't retaliated by increasing tariffs. So that's been helpful to the global economy.
We saw a little taste of the tit for tat, but just to your point about iron ore and China needing it, the tit for tat isn't really long lived in terms of threats because you look at the Chinese economy, they're reliant on global trade, right? So they can't really play hardball too aggressively.
Look, in the US, they're being very clever. I mean, the US at the moment, the way things stand, there's a 30% tariff on imports from China into the US, which is still relatively high, and there's something like a 10 or so percent tariff on exports from the US into China. But they are still talking, agreeing to maybe come to bring those down. But China do have a few very good points of leverage with the US. A is critical minerals. They need the US. They can get critical minerals from other countries, but it takes a long time to develop. And China at the moment is the main provider of very important minerals into the US, which is a big leverage point at the moment. The other one is soybeans. So the US farmers, they used to export a lot of soybeans to China. And China, a bit like iron ore, they've basically said, and in the case of the US, they have actually stopped importing soybeans and they're taking more from Brazil and Argentina, which is not great for US farmers. So that's, again,
great lever.
A point of a negotiating ploy that China can, really screw down on US farmers at the moment.
Yeah. All right. Well, moving on from tariffs and Trump and the Trump effect, I guess. Let's talk about two things: the labour market and property market. We'll touch on the former first. The labour market sort of forecast or update, wage growth, unemployment trends, and what that has an impact on inflation. I think we recently saw unemployment trickle up a little, not really at the level that the RBA wants to see it at. I think they want to see it around 4.5%, if I'm right. And I think it's around 4.2, 4.3.
4.3, yeah. 4.2, yeah.
And if it's, I guess the concern there, to call it out for our listeners, is that if it's around that 4% level, it can create upward pressure on wages, which has an inflationary effect.
Yeah.
What's your comments to all that and what we're seeing?
Well, so we've seen a gradual, easing in labour market tightness. As you said, the unemployment rate has drifted up a little. It's around 4.3, 4.2, depending on the month. It sort of ticks around those levels for the last few months. We've seen, jobs growth slow. Hiring intentions, there's other business surveys that, the degree to which businesses are looking for workers, that's come off its peaks, but it's still at relatively high levels. So our labour market I would characterise as still pretty firm, but not as tight as it was, 6 months ago. Now, on the wages front, wages are actually well behaved at the moment. So they're not flashing red in terms of inflation. Wages are at a level there's two issues. If we had normal levels of productivity growth in the economy, 1 to 2% productivity, then wages could grow at like 4% and still be consistent with inflation in the 2 to 3% target band. At the moment, wages are running around about 3.5%, 4%, but we have very little measured productivity growth.
What is our measured productivity growth?
Zero.
Oh, really? Yeah.
Now, one of the issues there is that a lot of the growth we're seeing is in what's called the care sector, disability care, aged care, healthcare, and these are service businesses, right? And there's very hard to generate productivity in these areas. So, think about disability care or aged care. It all comes down to staff hours per patient, and there's not a lot of ways to seemingly boost productivity in these areas. So that's one of the challenges at the moment as the growth in the services sector come along. We're not getting the productivity boost that we used to get when we relied more on, say, like manufacturing and construction and these sort of areas. But at the moment, I think the labour market I would characterise as it's not a barrier to interest rate cuts, because I think wages at the moment are sort of I think still broadly consistent with not standing the way of inflation coming down a little bit more, and the labour market is slowing. You mentioned the RBA; they'd be more comfortable with the unemployment rate at 4.5% because they think that would be consistent with wages at sort of a neutral level. But if it turns out that wages stay where they are and the unemployment rate stays where it is, I don't think the RBA is going to jack up interest rates or not jack up or not cut rates because it says, no, I want to see a 4.5%. That's what they think they need to see. But if wages behave at a lower level of unemployment, they'll change their mind and say, well, maybe we can accept a lower level of unemployment.
So essentially what you're saying, in short, is that the current levels aren't a deterrent or influencing factor for the RBA to make a decision on interest rates, right? We're at a safe level for them to focus on other indicators like inflation.
Yeah.
And speaking of that, we didn't have wage growth for a long period of time, and we've had consistent wage growth in recent years. I think, once again, don't quote me on this, but I think we saw the average wage now hit just under $110,000.
The average wage,
yeah, which is a big increase. I felt like it wasn't too long ago that it was only like $60,000 or $70,000, maybe 5 years or so. So we've seen a big increase in wages. Maybe doesn't quite compare to the level of inflation we might have seen. I think I read some data points recently that the living expenses, essential goods, have become, or essential living expenses has become a much larger percentage of the average household income, and that's increased at a bigger percentage than wage growth. Hence the bigger percentage.
Like electricity prices, for example, mortgages, and rents,
non-discretionary essential
food
costs.
Food prices,
and that's we're seeing that come through to some of these Gen Z protests all over the world. Because they're the ones that I feel like the income to house price ratio has got out of whack, and the previous generation have made all the money, and there's nothing left for them. But yeah, so I guess at the moment in the local labour market, things are looking okay. Well, I think will be the conclusion there.
Yeah.
Housing market, this is a hot one. And obviously our bread and butter, this is a property and finance podcast, and we haven't really spoken about the property market much, but I guess in short, the hot topics there at the moment, supply, which I think we did speak about back in 2023 because it was an issue back then. There were promises made back then by both federal and state government. Still not much has progressed, although actually I do feel the state government, Chris Minns, is at least attempting to make progress. He's having a few solid cracks at increasing supply and pushing councils out of decisions. We're approvals still, I don't believe, have changed that much, but we're heading in the right direction for increased supply.
Yeah, so building approvals have picked up a little, but they're still at well below, but below underlying requirements given the growth in immigration that we've had and growth in the population generally. We're still not building enough houses. We're building more. I mean, I think what the New South Wales government is trying to do is very, admirable in a way.
Yeah.
At least, because people have talked the talk for a long time, but this is a government that's finally, and overcoming a lot of NIMBYism in local areas.
He's putting decent proposals forward,
Yeah, so hopefully, my only, of course, if you build a block of units in Mossman, I don't know if many first-home buyers are probably going to be able to afford them. We'll see what the average price of them is. I think they'll still be very expensive.
All these 10,000 units apparently in Woollahra, these high-rises, was supposedly meant to be built around this new train station or this train station that's there, and and had never got commissioned.
Yes.
But yeah, there's other, just to call out some of those development or housing opportunities. I think, we saw the Rose Hill Racecourse that didn't go ahead, but that was a good proposition. I think that deserved to go ahead.
Yeah.
There's also down at, what's that area called over the Anzac Bridge, is a White Bay station just in front of it there, the Docklands. They're talking about potentially adding something like 10,000 homes there.
Around near Glebe Island, is it?
Yeah, like just on where those big, I think there's cement mills.
You got Edgecliff, Woollahra area.
The Woollahra station. I feel like that one was a political move because I can't see high rises going on Edgecliff Road.
Right.
There's not a much. When I say political, just to show that he's having a crack in the affluent areas as well.
Yes.
To upset the more affluent individual as well. But yeah, some of those areas like next to the Anzac Bridge there, the infrastructure is well suited for more homes, especially now with the West Connects. So yeah, I guess in summary, supply is increasing, but not much. Well, approvals have increased, which will eventually flow onto supply. Interest rates, we've had 3 cuts this year. Has, in terms of what we're seeing on the front line, definitely starting to have an effect. It's improved affordability and serviceability somewhat, not a huge deal, but definitely now making people a bit more confident to get into the property market. People are worried that the market might run again without them. Where we saw at the start of this month, 1st of October, the new scheme for the first home buyers deposit scheme that now takes people up to a $1.5 billion threshold with no income caps. That was a great sort of change in that policy. Previously, they had thresholds of income. What else is there probably to call out in the property market?
Oh, look, I just look the old fundamentally, as you pointed out, we have a supply constrained market, particularly along the east coast of Australia. So the way I think about house prices is basically house prices move to the point at which the average homeowner, given the current levels of income and interest rates, just can't afford to pay anymore. So it's affordability constraint. Now, as interest rates come down, affordability temporarily improves, but then that's quickly offset by prices going up.
Yeah.
So unaffordability ultimately stays the same. It just the composition of it shifts from interest rates to higher house prices a little bit. So I think what we're seeing at the moment, is as the RBA cuts rates, house prices respond, and there's probably more of that to come, and just the nature of it being a supply constrained market.
Yeah. Okay. Well, I guess the last topic I want to cover as we wrap up this podcast is just more about, Betashares investment products itself, because a lot of people don't know that. And this isn't a paid promotion, by the way, guys. This is my genuine love for Betashares investment funds. I guess I want to call out some of the interesting ETFs that you guys offer, and the ones that I like and I'm attracted to personally as an individual. So a big trend that we've seen in the last, I don't know how long, 5 to 10 years is index fund investing. People shifting away from active funds where these fund managers charge a higher management fee, a percentage of funds under management for buying and selling throughout the year, which triggers capital gains. Betashares has definitely been a beneficiary in the shift towards passive funds at much lower fees, roughly, I think 0.3, 0.4%, I think it is. Some of your
can be lower.
Can be lower, yeah.
Depending on what you want.
But the ones that I like, just to talk through some of these products, and then you can sort of add your 2 cents on them. My 2 main ones would be so I'm relatively young, so I like a bit of leverage in my index funds.
Yep.
So 2 index funds that I love are GGUS and Gear. So GGUS is a leveraged index fund against the S&P 500, which does include some of the NASDAQ tech stocks. So you do get some exposure to the tech stocks. I think it's geared at 2 times.
Yeah, 2 to 2.5.
2.5. Then same as the Gear, same thing, but ASX 200. It's less attractive sometimes than the US exposure, although we've had great growth in the ASX recently. We've hit all-time highs in both those markets, I think this week even. The other ones I like, banks, which is a global banks ETF. AMRA, that is a global defense ETF. Definitely see some good growth in those stocks. As we see, I was going to ask you about investor sentiment, but given as we see equities approaching record high valuations, when you talk about multiple of earnings, we've seen a real shift into fixed income funds and bonds. And you guys have a few good products there. CRED, I think it's CRED, and another one I like is hybrid, which are fixed income funds and bonds. And then if you're a bit over the index funds and bonds and some of those defensive stocks, two other ones I like are DHHF and GHHF, which are I forget which one's which. I think G is a geared high growth fund, and DHHF is just a growth fund, global, I believe. But I get last two shout outs in my personal portfolio that I love: Fuel, Global Resources, and Game, a gaming. The gaming ETF, and we've got a great gaming industry in Australia. And when I say gaming industry, I'm not talking about all the kids playing video games. I'm actually talking about the companies that produce the actual games. And in Melbourne, some of those companies are global companies, right? So, did you want to talk to any of those funds?
Look, I like everything that you've mentioned there. I mean, you're a very astute investor there. So the CRED I like is a fixed income fund. It's a corporate bond fund, but it's a longer duration fund. So it gives you good yield. But if you get a risk-off environment where equities maybe don't do so well, but central banks cut interest rates to support the economy, CRED does very well in that environment.
Hence, it's defensive. You could say.
Yeah, it's defensive. But it gives you basically, because it's a corporate bond, it's a little bit more. If equities sell off, corporate bonds tend to underperform government bonds. Getting a little bit technical, but you get a higher yield by taking on that risk of corporate bonds. But the beauty of them being long duration, they benefit when overall level of interest rates fall. So although it's a corporate bond, the value of that can actually still hold up pretty well in a risk-off environment, even though it's a corporate bond. Yeah,
that's why probably having a few different fixed income ETFs might be prudent. There was another one I actually forgot to mention that I'm not in it anymore, but it was the US Treasury one, GGOV, which is then what the latter
very long duration Treasury, long duration government bonds. And so they're really a hedge against an economic downturn that requires central banks to cut interest rates to support the economy, because fixed rate bonds do very well in those environments. And at the moment, I actually still think they're going to do okay, because central banks, we're not facing recession. I know my base case is not recession, but we are facing inflation still coming back down somewhat, and interest rates still at restrictive levels, and central banks having a bit more room to cut rates. So that should be supportive of bond yields, which in turn is supportive of bond valuations. The only thing I'd add to what you mentioned some of our more highly geared funds, such as GGUS and Gear in terms of the Australian market. We have recently introduced what we call more moderately geared funds. So instead of like it being 2 to 2.5 times leverage, it's more like 1.5 times. And just one of the from our modelling, from a long-term perspective, that can give you they're more suited for like real set and forget long-term investors, maybe younger accumulators. Having that more moderate level of gearing can still give you very good, good long-term returns. The thing about the more highly geared ones is they can maybe erode a bit of value when you get a high volatile
because to call that out, because essentially the funding costs, right?
Yeah,
they eat away at your margins if we've had flat years, let's say.
Yeah, and just also just the rebalance. Like these funds need to be rebalanced every now and again to keep the leverage ratio the same. And so when you get a very volatile market, when the more highly leveraged you are, the more that can eat into returns. Not remove the returns, but eats into it a bit. So we kind of see them as more shorter term. More, definitely could be long term, but more for like short term trading opportunities. If you think the market's going to go up for the next few months, go into GGUS. But if you want like a 30-year or 20-year or 10-year I'm a young investor. I've got time on my hands. You don't need to just invest in the share market now. You can invest in the share market with a little bit of leverage.
Yeah.
And it just gives you a bit of an extra kick, over those years. So
yeah.
we've got
they're the accumulators as investors, right? Well,
yes.
And I'm calling this out because we do have a financial planning business, and these are the type of products that our financial planners do recommend. Obviously, all this is general advice, and there is a disclaimer at the end of this podcast. I guess just one call out, I definitely don't buy these more aggressively leveraged ETFs for a short-term investment approaches in. I don't think anyone should be looking at it as a 3-month gain unless you're a real sort of sophisticated, astute investor that can has a lens on something for a certain reason.
If I may just jump in, the one other standout of the past year has been gold. I mean, gold's been going gangbusters, and not necessarily say it will continue to go gangbusters, but I think the outlook is pretty good. The US dollar, I think, is still weakening, which will support gold. So we have two ways to play gold: gold bullion through the QAU ETF, and global gold miners. MNRS is the ticker there.
I'm in that one. That's been performing. Yeah,
there you go again.
Yeah, there's actually, and on that note, there's other ones here I didn't call out that you guys offer. You've also got crypto ETFs. I think there's one called CRIP that is about businesses in crypto, and then you've also got a Bitcoin and Ethereum ETF that I like. I think it's QBTC and QETH is the Ethereum one. Just want to call out a couple of things there. So when we say defensive stocks or defensive positions in these fixed income funds, what's also obviously being fixed income and low volatility is defensive in itself. But what could be what I like about it, so my personal opinion is that in times of uncertainty, if there's ever any drastic sell-offs in equities, which we've seen multiple times in recent years, you can exit those funds and use those funds that haven't sort of had the same sell-off and purchase maybe some of these other index funds that are maybe leveraged or not, but have a looking like good value to enter. So it gives you some cards to play with, let's say, in your portfolio. The one last thing I want to ask you about before we sort of wrap up today is just to explain the high growth ETFs, so DHHF and GHHF, so diversified all growth or high growth. They're mid caps, I believe, or how are they structured?
Well, I think there's a combination of like global and Australian equities. I mean, I think they're generally large cap companies. They're just the difference is you're just getting a broader blend of both the global and Australian equities. In the case, it's basically a blend of Australian and global equities, and one gives you a bit of gearing, and one doesn't give you the gearing. They basically give you a growth portfolio that blends both Australian and rather than buying an Australian equity ETF and a global equity ETF, that it blends the two into one. So that's the and then so you don't have to buy, you can buy one instead of having to blend two. So it's a diversified equity portfolio, and then one does it without leverage and one does it with a bit of leverage.
Yeah, naturally, I do sort of lean towards the leverage one. All right. Well, David, thank you so much again for your time. It's been good to reflect on some of our previous discussions and talk about much more relevant crystal ball forecast now today with what's going on. Appreciate you're also a highly sought after individual these days. I've been seeing your name popping up on podcasts left, right, and center, or just media left, right, and center. So thanks for coming in. I will not leave it as long between sessions this time. We won't wait for 2 years. I'm confident we'll see you again in the next 12 months and we can reflect on some of these discussions. So thank you so much.
No worries. Thank you.
And thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcast. This business is built on word of mouth, so please refer us to all your friends and family. They just want to stay tuned to the latest property and finance tips. Thanks again. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast. Now let's dive into today's episode.